The other thing that's interesting too is that over 43% of American families rely on investors to provide them with shelter to rent. It's a surprisingly high number. And you know, we've consistently, since 1970, we've seen home values grow 62%. So there's been like an average of 5.2% appreciation, including the current economy we've had. So long term, it's a good hold. So in this situation here, what we're going to cover tonight, we're going to basically go over compare assets with growth potential. We want to cover the benefits of real estate investing, the truth behind some of the myths that are out there, and how you can optimize investing in real estate, of course. Go ahead. So basically, we're going to try to give you a high-quality presentation here, but the thing is that I always personally, this is kind of my own motto, I always do what's best for you and never let you close on a bad deal. I look at investors as being reoccurring customers. You're going to come back to my store again and again, or whoever you're using. And that's one of the common things that we should talk about first. You don't have to be exclusive. I mean, I get it. When you're an investor, investors have multiple sources of properties, and it's because of the creative ways you have to get to those properties that require that, okay? So real estate, right now, I only want to talk cash flow, because that, like appreciation, depreciation against your taxes, those are bonuses. Right now, we just want to talk straight cash flow. Real estate investing, it should be a non-emotional event. It's all about the math, and that's what's interesting about the way we market nowadays. As an investor, you're going to start looking at things like cap rates, cash on cash. You want to look at it differently. The price really doesn't matter. It becomes irrelevant based on, you know, what is the rent in the area and what can we charge for that. And obviously here, as an investor, we play a vital role in real estate marketing, and I think that you deserve a lot more respect than you get. Because I think a lot of us that are out there, you say, oh, an investor wrote another offer. An investor is representing a lot of our market. A lot of times they represent cash. A lot of times they represent a solid investment that now that property is being taken from a situation where it might be a distressed property. Now it's actually an owned, rented, positive part of the community. With me, you guys can read through this later, but basically I've been in the business about over 20 years, been 16 years with Remax. You know, I really came out of the new construction industry. That's where I come from, remodeling. So that's where, what's fun about investors is we go out and we actually look at properties. We can point and talk the talk. You don't have to wait. And a lot of times that helps you a lot when you know what you're doing, especially you guys too if you have experience in that arena. So we do a lot of business too. Chris and I actually, Rooney that's with me on the show, we have a lot of relationships with local banks, you know, where we actually, and the national banks. So if you guys are looking for properties, we have our first look program where, you know, if you guys want to get on our list, we'll send you out stuff. You can look at it first. We send out and analyze, so there's no math to be done. Okay. Jeff here. Jeff O'Brien, introduce yourself.
My name is Jeff O'Brien. I'm an attorney with the Lommen Abdo law firm. We're headquartered in downtown Minneapolis. We also have offices in Hudson, Wisconsin, and one attorney in New York City. My areas, I practice business formations, business transactions, real estate law, which is why I'm here tonight, estate planning, and a little bit of probate law, which kind of all wraps into the real estate stuff in terms of forming an LLC and doing the transaction and planning for, you know, future issues. I'm certified by the State Bar Association as a real property law specialist, so which means, it doesn't mean that I'm some kind of real estate genius. It means that I do a heck of a lot of real estate work, so in a lot of different areas of real estate. So,
thank you, Jeff. Jeff's going to really key in for us too on the self-directed IRA. So if any of you guys are interested, is anybody here to talk about that at all too? Good. Yeah, that's where we're actually taking some of our portfolio, investing into real estate, and there's some really exciting advantages there too. All right. Okay. This is one I think a lot of people, they think real estate investing is only for the wealthy people that are out there. And what's interesting is that the average in 2011 median income for an investor was $86,000. 39 made less than $75,000. 58% of those made less than $100,000. And I thought that was interesting because it's, I mean, if you get a dual income family, that's a normal family in a lot of cases. Not in every area, and not in, but it's interesting. So you look at, here's kind of a quick little splattering of all the different properties that were purchased, where their incomes were. There's a majority of these are down here below in the 50 to 60,000 range, which is just kind of interesting stat. So our average income as an investor, and I only bring this up because I think it's interesting, because this is your competition too. You got to remember, in any competitive environment, you're competing against other investors. Sometimes it's good to know who you're competing against. We kind of went through that already, but let's. Okay. You know, one of the things that with investment properties was about 100,000 in 2011. That was, I tell you what, that was kind of the magic number. Everybody came out and said, I want to buy a $100,000 house or less. I think it's because it's a comfortable number. You know, it's not that it means it's a good number or a bad number. It's just that from a purchase perspective. Different ways to invest. Leveraging, we're going to talk about here. And then, of course, Jeff with the self-directed IRAs. Go ahead. A lot of our properties now are through, like we talked about here, the short sales. And obviously through REO properties. REO properties are down 48%, guys. And what we're finding is another great source for these are traditional sellers that own their properties free and clear, and they want to get some cash out of their property. That's where some creative stuff, you know, like our next level of investment class we can get into where we get some carryback from sellers, creative financing. So if you're leveraged and you got a couple properties, traditional sellers are good too. So the videos won't run? I apologize, you guys. I do have a series of videos that's supposed to run with this that we have that what I'll do is if you guys leave me, I'll email you my link to them. You can watch them at home. They talk about different parts of this that it makes it a lot more exciting than just me talking. So here's one of the, you know, a lot of people used to think rental properties are only like at the lake or down in Florida or, you know, in resort communities, and it really only represents about 8%. Most of and a majority of are in rural areas, suburban, and then, as it says, small towns, which I found to be very interesting, especially small towns. So, you know, an investment property, again, I don't know if you can read this, it's kind of small. 75% are in the small towns and rural developments. 48% are within 20 miles of an investor's primary residence. And if you don't have any properties yet, and you're getting your first property, you're going to get a call at 11 o'clock at night, and there's a toilet that's overflowing, and that's every investor's nightmare. It's a lot easier to go 10 blocks than it is to go 10 miles. And I recommend that until you get your feet wet and you try it. That's my dad's advice. My dad owns dozens of properties, and he's always said keep it close to home. And it seems to work out better, at least for your first couple. Okay? Now here's an interesting thing. They talked about, you know, okay, so talking about investment properties and different bonds and certificates of deposit. Here's bond yields since 2000. You know, 6%, 5%. It averaged 4.2% on the bond market. 6-month CDs, which a lot of people like because they're cash, they're liquid, is only averaging 2.84%. Mutual funds, now this is on a 10-year return. We've only been seeing, and this is the volatility of the marketplace, we've only been seeing about a 3.6% 10-year return. Of course, results may vary based on if you have a better financial investor or advisor. Usually the other thing that people don't like is that they're managed by somebody else. You can't touch them. Also, you get a piece of paper that says you lost $100,000. But you don't lose the house usually. You know, usually the house is still there. You can tangibly go see it. Dividends are reinvested and not paid to the investor. That's that cash flow statement again. And if you don't want derivatives that pay cash or you don't want your investment, you take that and you roll it back into your payment so you buy down that asset faster. Okay? This is showing real estate, what's happened over traditionally since back to 1969. And showing you where the appreciation has happened. It's fluctuated, and just until recently did we start seeing the dips. And this is where we were talking about having that 40-year average of a 5.2%, but overall a 65% return since 1970, which is pretty interesting. This is our stock market. We've been through this. I mean, we watched it up and down, and it's going to keep doing that forever. I mean, that's just the way the markets are played. But some people nowadays, when they got scared the last time, when you start dipping down this low, that's where people get scared. I mean, I know I did. And you start seeing your entire savings and future disappear right in front of you because of a paper decision. And that's where all of a sudden now you see people buying gold, buying investment properties because they want to diversify. Okay? Stocks, again, no surprise here, watching the volatilities of the markets. If you invested $1,500 back in 2000 in the stock market today, that $1,500 is worth $1,469. If you would have actually, in the same scenario here, we actually put it into real estate, and that's actually where it went up, came back down. We averaged right that same amount of money at $140,000 purchase, ends up being about a 20% increase in value, even with the ups and the downs so far, and that's since 2000. Okay. Now, if you bought 2007, like a lot of our guys did when there was 0%, no money down, no verification, they're still down. So anyway, what they're trying to basically show here, initial investment of $100,000 in stocks. Over time, what they're looking at here is you basically in real estate will have $207,000 or a positive 107% return in that same period of time versus the stocks have actually in some cases have gone down as much as 69, and that's the last 10 years again. So And that doesn't have this year, which was actually decent year for stocks, to be out there. Okay, so cash flow. This is where one of my first videos starts. And the whole idea of cash flow here is where you're actually taking something as simple as taking your renter. Your renter pays you rent. Out of that, you're paying your taxes, your insurance, management fees, maintenance fees, and mortgage. Those are your expenses. Whatever's left over is your cash flow. So that scenario there, we're a couple $100 in cash flow based on that scenario on the 2011 example. Appreciation, again, I said this before, we should always consider this to be a bonus, but yearly appreciation has been above 5%, 5.2%. Like I always say, when you look at the flow chart, and this is where I missed my video because the video shows a really good job of this, they show the properties as they appreciate, okay? And then they show you as you can depreciate a property, and then they talk about basis points and all these other terms that we're going to go through here in a little bit. And it just shows you how, if you forget about appreciation, a cash-on-cash return, for example, of a $25,000 investment on a $100,000 house, you put 25% down. And at the end of the day, your appreciation, let's say the house goes up to 5%, so you make $5,000. What they're doing is they're putting that $5,000 on the $25,000, that's the cash-on-cash. So it actually is making like a 20.8% return is what they're trying to say. Okay? All right, this is showing us again projections showing where they think things are going. This is since 1970 showing the line. They're very close. Then we went crazy for a while. That was back when the building was going nuts and financing was for everybody. And it came back down, and now they're projecting we're going to keep going steady. Okay? Now this is the power of leverage, okay? So if you have, when I use the term leverage, we're talking about taking your money to finance something, to buy something, okay? Talking about that cash on cash. Go ahead. So, you know, if you have $1,000 to invest, you usually have $5,000 in buying power, so it's usually 5 times, you know, roughly 20% down is what you want to have, okay? All right, there's also benefits when it comes to the taxes, and depreciation is something that when you depreciate a property, and we'll talk a little bit more about this probably with Jeff, you're going to take that depreciation and we look at a total of, I think it's, we don't depreciate the land, we depreciate the buildings, we depreciate the actual structure itself over 27.5 years, so that ends up being like a 3.6%, something like that. Of 3.63% annually that we depreciate. But keeping in mind that when you do depreciate or the tax benefits, if you are Section 8, which a lot of renter income is now, you cannot, because there's a tax gain there, so you can't obviously depreciate a Section 8 or some kind of a like historical building in that case as well. Okay. Some of the fun things you can do, advertising, cleaning, depreciation. If you're on vacation and you went out with a real estate agent, you looked at a couple potential properties, those are expenses you can recoup as well against your taxes. There's a lot of benefits there. Insurance interest, I mean, obviously you guys can read, I don't have to read it to you. There's a lot of advantages of owning the rental properties. Okay, yeah, we'll go back. What they're talking about in this situation here is when you think about depreciation, why do they give you depreciation as a tax shelter? The idea is this: carpet's going to get worn out. That is going to not be the same when you get that rental property back in 2 years. You're going to have to replace your carpet. So that's what the depreciation is for. If you're my dad, you take the depreciation because you like to just have no taxes going out the door, and he doesn't worry about the consequences because he's going to give them to his kids, and he doesn't care. So he depreciates everything the maximum that he possibly can, but that's, you know, his personal strategy. It doesn't mean it's right or wrong. It's just everybody has their own unique strategy. Okay. Here's how it works. Take a $100,000 property, and then we've got $85,000 attributed to the improvements on the house. The basis of depreciation then would be $85,000. Okay. So when you calculate your first year's depreciation based on from the month of purchase, you take a 3.3 or 63%. So on your taxes, you can deduct about $3,000 in that scenario per year for 27.5 years. There was some scary stuff here. This is where I'm going to let Jeff kind of jump in here too. With the amount of Americans that are out there that actually have, there's 320, give or take a few, million people in the U.S. 180 million people have some form of a retirement account, okay? The average balance in those retirement accounts is $48,000. pretty low. And 4 million of those people actually have something called a self-directed IRA, and it's growing every day in popularity. Okay? Let's go flip through there one more time. Okay, do you want to jump in on your deal now here, Jeff?
Sure.
Take it? Okay.
Sure. Well, I'm going to talk specifically, and there's a lot of different issues that you deal with legally from my perspective in terms of being working with real estate investors. But what Andy wanted me to talk about tonight is, and it ties into what he was talking about earlier about a lot of people, because of the volatility in the stock market, looking for alternative investments to make inside their IRA. And a lot of folks, I would say in the last 5 years, I've been working with a lot of clients that are using what's called the self-directed IRA to acquire real estate. And just a little bit of background. When I was approached by this and brought to this topic by clients of mine, at first I was like, what is this? I hadn't heard of it. And it was clients of mine that said, I want to do this, I want to do this. Met with the folks in town that are more knowledgeable about this, started to educate myself, and have, over the past several years, worked with a number of clients that are doing this. There are a lot of legal and tax issues involved with it. It's not for everybody. You do have to work with your professional advisors in order to do it. Well, let's talk a little bit about it. There's a couple things I'm going to talk about, and I'm going to try to go through this as quickly as I can. Some of this is really kind of hyper-technical stuff. I did put in the little red packet, there's an article called Alternative Investments Using Self-Directed Retirement Funds. This one goes into much greater detail about some of the different aspects of self-directed IRA investing. Where I came to it, also, you hear stories of people liquidating their IRA, paying the tax and penalty on it, and then using it to buy real estate. And what I've found out is you don't have to do that. There's a way. You use a product like this and work with an administrator that can set up this kind of account, and you don't have to. If you follow the rules, you won't be paying those interest, tax, and penalties. So we're going to talk about what is a self-directed IRA. We'll talk about one of the hot button issues that you have to worry about if you're going to use it for buying real estate, which is self-dealing issues. We'll talk about how to have what's called checkbook control over the IRA funds by using a limited liability company. And then we'll talk about a couple other legal and tax risks. So what is a self-directed IRA? Well, it actually isn't anything magical. It's just simply an IRA. The difference in the self-direction refers to the IRA owner's own ability to direct where the IRA funds are invested, as opposed to using a financial advisor or wealth manager. Now, if you go to any financial advisor or any wealth manager, whatever they call themselves, they could, within your existing IRA, purchase real estate. The reason that they don't typically want to do that is, number one, it competes with the proprietary set of funds that they have, and it takes away assets under management. And number two, it's a practical reality. It's darn hard to administer it. They're there to manage money. They don't want to have to worry about, paying utility bills and collecting rent checks and all that other kind of stuff. They don't want the hassle of having to manage real estate. So there are some, like I said, there's some administrators. There's about, I don't know how many in the country now, probably a dozen or so. Some locally, some outside of Minnesota, that are set up, or will help roll over your IRA funds into a new account. It could be traditional or a Roth IRA, just like you would with anybody else, any other advisor. And you can specify where that money is invested. It could be, like Andy mentioned, could be gold, silver, those things. Most commonly, folks are using it to buy real estate. Like I said, self-direction allows for investment into alternative investment assets, real estate, precious metals, things that your financial manager isn't normally going to be handling for you. Some people that want to just take it and self-direct and then buy stocks, you might as well leave it with your existing advisor, because it does the same thing. It's for these alternative investments. So the big thing to be worrying about, and this is why you have to have an attorney and accountant be advising you throughout this, is the self-dealing rules. Section 4975 of the Internal Revenue Code it says that the IRA owner can't use the IRA funds to engage in certain prohibited transactions. And if they do, that's what triggers the taxes, penalties, and interest if they're younger than age 59 and a half. It's deemed to be a distribution. A prohibited transaction is simply put a transaction involving a disqualified person. I'll get into that in a minute, what the different types are, and then we'll talk a little bit about what disqualified persons are. But in a nutshell, disqualified persons, the most common ones you have to deal with is your spouse, your lineal descendants, parents, and children, and their spouses. Those are the folks that you get into issues. I've had some people come to me that they said, I want to buy a property through my IRA. I'm going to manage it through this company that I have set up that I own personally, and we're going to lease the property to my wife's business. Self-dealing on the hands of you managing, taking money out as a property manager, self-dealing and doing a lease transaction with your spouse, because they're saying even though she doesn't receive any money for it, she's getting the benefit of the use of the property, which is an asset of your IRA. So those two areas would be examples of self-dealing. Can't do it. Prohibited transactions is a long list of and you can see the sale or exchange or leasing of any property between a plan, which is the IRA, and a disqualified person, lending money or other extension of credit between a plan and disqualified person. I've had this scenario come to me. I want to use my IRA funds to retire an equity line that I have on my business or my property. Can't do that because you're lending money to you're a disqualified person yourself as the IRA owner, and you can't lend money from your IRA to yourself personally. Transferring assets of the plan to between a disqualified person. This is tricky. If you're going to do investing for your real estate for your IRA, a lot of times, and Andy can vouch for this, if you're going to go to an attorney or have set up what's called a limited liability company to own real estate, you do that for limiting liability with your property. A lot of times you may pay for the property at closing individually because you didn't have enough time, or it was moving so fast you didn't call your attorney and have the paperwork set up. And you report a quitclaim deed to the LLC after you have it set up. Now there's a number of other reasons why that's a bad idea, but that's beyond the scope of tonight. But in this case, in the self-directed IRA context, you can't do that because you can't take an asset that you own and do a transaction and take the money from the IRA to yourself personally. That would be a prohibited transaction. So there's another example of a prohibited transaction. So we said all these different things. And there's like so the article goes into a little more detail in terms of what the code actually said. Okay. This is the whole and exhaustive list from the Internal Revenue Code section as to what disqualified persons are. I'll narrow it down for purposes of it tonight. We talked about lineal descendants. You as the IRA owner, your spouse, your children, their spouses, parents, but it also extends to corporation or business entities that are controlled by those folks. And in the control test, it's going to be, typical control is 50% or more. If a disqualified person has the ability to direct how those funds are used, has that kind of control, the IRS takes the position that that's going to be deemed a distribution, and the taxes and penalties are going to trigger. If it's 10-20%, that's a different story in terms of the control. Okay. We'll talk a little bit about checkbook control. And this is where I come in. Even an administrator that will set up a self-directed IRA, they don't want to. They aren't necessarily a property manager. They aren't necessarily a licensed real estate agent. They don't want to be handling those things doing transactions for the benefit of somebody else that would require a license. Plus, to try to manage a whole bunch of real estate for thousands of clients would be a little bit cumbersome. So you talk to most administrators, and they will suggest that you set up an LLC, and it's a case called Swanson versus Commissioner. It's a tax court case that established the principle of checkbook control, basically saying you can be the IRA owner. You can set up an LLC. You can fund the LLC with IRA funds, and you can be the manager of the LLC, and be able to have a checkbook, a bank account for the LLC, have a checkbook for that bank account, and be able to pay your property manager, or pay your contractor, or pay pay the utilities, pay different things related to the property out of that checkbook. That's what checkbook control is about. Okay. So the ideal entity for real estate investment, IRA or not, is the limited liability company. The IRA in this case owns the LLC, and the IRA owner can serve as manager or governor of the LLC and have control over the LLC.
I have a question.
Yeah.
The lineal descendant, does that include a sister? Or
No, that's a good question. Sisters, cousins, step-parents, step-children don't count. It's children, grandchildren, parents, and then spouses. Like I said, why would you use an LLC besides the IRA context? LLC provides a liability shield over a member's assets, and then single-member LLCs. These are very cool things. For a long time, an LLC was considered that you had to have at least two members, and they were because LLCs grew out of partnership law, and so that's why you can't have a partnership with only one partner. You have to have two people. And about 15 years ago, 16 years ago or so, the IRS finally allowed single-member LLCs, and so it becomes a no-brainer. If you're going to own real estate, whether it be you individually or through your IRA, if it's just one owner, the idea, I can cite chapter and verse of the number of cases that are out there in the state of Minnesota dealing with litigation involving against a property owner. Specifically, if you're buying property for use as a rental property, there are some. I always cite there was a court of appeals case probably about 3 or 4 years ago, and the case involved it was a claim of negligent supervision against the owner of an apartment building because the kids were staying with grandma and pushed the bed up against the window and were jumping on the bed, and the kid one of the grandkids fell out, went through the screen and fell and died. It fell out like about the 3rd story window. And the court ultimately ruled in favor of the landlord, but I bring it up all the time when I'm talking with groups of investors and potential landlords to show you that the bar to get, most of you probably think that is an absurd case. Why would you say that would be negligence in any way, shape, or form? The fact is it got to the Court of Appeals. Okay, so the bar to be sued in this state is very low. So it's a no-brainer, in my opinion, to have an LLC as the vessel for owning your investment real estate, rather than have you sued personally and have all your other assets on the line if there was an event of a lawsuit. And the corollary is that if you own multiple properties, yes, it's a good idea. Despite the cost of having someone like me set them up, it's a good idea to have them in separate LLCs so that only one property is on the line if something happened. In particular property, you don't have number of properties under one LLC. It would all be assets that could be breachable. So, okay, so checkbook control with LLCs. We've got required documents, articles of organization. You file those with the Secretary of State. There is a form on the Secretary of State's website. It's the bare minimum. There are a number of default provisions in the LLC statute that, if you go to me or any other attorney, we can help you. We can help you deal with those provisions. Bylaws, also known as an operating agreement. We have contribution agreements. In the self-directed IRA context, the administrator of the IRA, which is the third party, they will sign that contribution agreement. You specify exactly the amount that you're contributing from your IRA into the bank account for the LLC to get started. There'll be some written actions of the Board of Governors, and you get a tax ID number, which is the Social Security number for the LLC, so that you can go ahead and open the bank account. We'll talk just briefly here about the other risks of doing this. And like I said, this is not for everybody. A lot of folks that come to me and want to invest in real estate through their IRA have done their homework and have done some studying on it. I would invite you to start by, if you're interested in doing it, start by reading this article. You go out on the resources, and by all means, you can contact me as well. Unrelated business income tax is simply when you have an entity such as an IRA that is normally exempt from income tax. If it engages in certain activities, there can be that's unrelated to its primary business, and they always use the example of a nonprofit entity that's also leasing property, for profit. That's an unrelated, business activity that could be income tax from it. There is a list of items that would be subject to UBIT. There are exceptions that exist, and yes, rental income for the most part is exempt from UBIT. There are some situations where it does apply. Again, another reason to work with a CPA and other professional advisors when you're doing this, which is the moral of the story, is you just consult with your advisor. So, yeah.
A couple of questions. I take it that any payment to you as the owner of the IRA for work you do on the property is a prohibited transaction?
Good question. Yes, that's correct. That's correct. And it becomes, it's one of those things I said, and people kind of say that's absurd. I don't make the rules, the IRS does, and of course it's the IRS, so you always have to obey the rules that they set up. But you can't even cut the grass on a property that you own because it's an
well, if you get away with it, this is the problem. There's a lot of people that say, I'll get away with it, and then you get audited, and then your IRA no longer qualifies, you're taxed.
Yeah.
Plus penalties, plus...
Yeah, it's a serious deal.
You betcha.
Yeah.
Is it possible for two unrelated IRAs to jointly purchase a piece of property? I mean,
yes.
When I say unrelated, I mean, say my brother owns one and I own one, and we can merge.
Absolutely, absolutely. In fact, you are able to purchase a property. It gets complicated. I haven't been able to do it. You can purchase property within an LLC owned by you individually and your IRA. Your IRA has to own the majority of the LLC. So you can't use the IRA for 20% of it and you put in 80%. You can partner with your IRA as long as you have, but you don't do things like putting together a buy-sell agreement. You don't have those kinds of triggers and those things. So yes, it can be done. It's tricky.
In other words, if you didn't have enough money in your IRA to consummate a transaction you had in mind, you could take your own personal non-IRA resources and merge them.
Yeah, you could set up an LLC, a two-member LLC owned by you personally and the IRA. The IRA has to own more than 50%.
Okay.
And if you're buying the property, you spend the money to fix it up, you turn around and sell it, make a profit, you would split the profits pro rata between the two of them.
Another idea for you, Pete, there's actually there's a group out there, actually, IRAlending.com. It's a North American Savings Bank. With a 70% LTV, they'll loan you money using the 30% out of your IRA. 65% on multifamily. So you actually can take your IRA money, get a loan as using your IRA money as a down payment. What I'm also seeing a lot of with our customers that are out there now, they're using IRA funds to fund like somebody else's, almost like a hard money lender capacity, where you become the bank. You may be one of three participants, and you're giving that $100,000 or that $50,000 or whatever you're giving, and there's a return on it that comes back to the IRA. Again, you don't touch it.
That's a very good point. I'm glad you brought that up. There are a lot of investors out there that are using their IRA funds just for that, doing basically hard money lending. See, the key is the problem that people have. Let's say, like Andy said, that people usually have about $40,000, $50,000 in their IRA account. Maybe that's not enough to buy the property. They need some extra money, or let's say that they thought it was enough to buy the property, but they didn't have enough to make the improvements to fix it up and increase it in value. You can't if you go to any bank these days, of course, you're going to be asked with your LLC, you're going to be asked to personally guarantee the loan. You can't personally guarantee a loan to your IRA as the IRA owner. So the only kind of lending transaction you can be involved with the IRA is what's called a non-recourse loan transaction, meaning the only thing that the lender can do is foreclose upon the collateral, the property, and take that as their measure of relief. there are investors out there that will do that for 14, 15, 16% interest rates, just like any other hard money rate. You know, and I work with a lot of folks all the time that are doing maybe a 6-month or 3-month short-term loan, high interest rate, but giving enough money to the IRA, to the LLC owned by the IRA that's fixing up the property to get the increase in value and turn around and sell the property. So yes, there are a lot of different nuances you can do with once you have the IRA LLCs out.
Yeah, there's like one bank in the country that we can find that actually will lend an LLC through an actual IRA. They don't want to do it. Otherwise, it's hard money lenders, or like I said, you can facilitate as a bank. Because think about this, guys. When rates are low, it's hard for people to qualify for mortgages. And what's everybody telling us right now? Rates are going to stay low through the summer. They're going to stay low. It'll be harder for lenders to give money when there's the little return. They don't want to take a lot of risk. As rates start getting back up there, 15, 16%, someday they never get there, but they'll give money to anybody then because the rates are so fantastic. So as rates stay low, you're going to see, I think, a market over the next 2 years where we're going to see the need for what they call hard money lenders, or as we call them, creative financing. Because let's say that you find a property and you want to flip it. You know, amongst all your other investments, you find a house, you want to fix it up, you want to flip it. There's hard money lenders out there that provide a very valid service in today's market. Quick money, quick deals. You can put them back on the market in a fast pace of time and get them sold and make a nice profit, and which we're really not going to cover tonight, but it's one more thing to think about. So.
That's a little different than the outfits you're mentioning that would give you 30% loan to value. That was on the acquisition.
Cool. Right. It's on the purchase. They appraise the property. It's a 70% LTV, and you're putting your 30% on your IRA, and then they're giving you a loan for the remaining 70%.
Yeah, I mean, these high interest rate lenders are the guys that come in after you got the property where you want to improve it.
Yeah.
To refinance it.
You sign a voluntary foreclosure that you'll give them the house back in 6 months if you don't have it sold. Oh, it's pretty scary, some of them.
Oh, yeah.
I've seen some of them where you're like, feel like you're doing a deal with the devil. You're like, here you go. But, you know, if you can make $50,000 and flip a house in 30 days, that's the risk you want to take. Those guys are out there, and gals are out there if you need them. So.
Yeah, the name of that bank that makes those 30% loans?
Yeah. It's the, if you look them up on the internet, it's actually IRAlending.com. It's the North American Savings Bank. I believe they're out of North Dakota. Weird. That's where all the money is. Yeah.
I've had a few clients that have done that. They use their IRA funds to buy real estate, and they haven't used NASB. So
Yep.
they are but one of the few that will actually do it.
Yeah. All right. Any more questions for Jeff? Otherwise, Jeff will hang around for a few minutes. You can shut the slideshow down. I'm gonna try to run through some. Thank you, Jeff. By the way.
Jeff, I think you did say, or make a point of it, but just to reiterate or clarify, I guess, the rules are the same for Roth and standard IRAs in terms of the real estate ownership.
Correct. Yep. The only difference, of course, is the way, the difference is any other traditional and Roth IRA would be different.
Okay.
All right, I'm not going to bore you guys to death here, but what I'm going to do is I wanted to go through, this is let me do it this way. Anybody here already an investor that's out there buying properties or owns properties? Okay. Mind sharing, you guys, what do you have or what do you do?
I've got 3 individuals that I've had for a number of years.
Okay.
Yeah, I'm looking at what you're talking about now, I'm thinking, man, I ought to be looking at getting into this now rather than getting out of it.
Yeah.
But in fact, I guess I'm certainly looking at maybe some possibilities of how can I get out of the hands-on aspect of it.
Good. Yeah, well, and that's we actually have a couple, there's a lot, I mean, you hear them on the radio now, it's a big business right now, the renters business, of finding you guys renters, and that's something I didn't put in the presentation, but I can tell you, they usually charge you a placement fee, which is usually equivalent to about 1 month of the rent and then they charge a management fee of around $79 to $99 a month to collect the rent. Instead of running over and fixing the toilet yourself, these guys actually will send somebody out there, you authorize them to do repairs up to a certain dollar amount. So it's a management company. So like for somebody like my father who's got a portfolio of properties, he likes that. All the phone calls are taken care of. He writes out a check every month and they tell him what he profited. You know, some people like hands-on. I mean, I'm hands-on with my stuff. I mean, I'm the guy fixing the toilet. I'm asking them why they had their kid flush the car down the toilet, and next time you're paying for it. I mean, but I'm a little different. I'm more hands-on. So how about yourself?
We had 3 singles. I'm down to 1, looking into multi-family.
Okay, cool. That's a whole different animal. I mean, you know, multifamilies, this is, okay, different kind of renters sometimes, you know, a little more transient or they want to flip faster, but what's nice is if you have a quad and you lose one renter, you're only down 25%. So there's pros to that. I mean, we were selling up in Fridley, geez, 2 years ago, I was selling fourplexes for $200,000. I mean, and they were renting out for like $850 a unit. I mean, they were making really nice money, you know, so that's yeah, thank you for sharing. So with this here, you guys, this is just what I call this is one of the spreadsheets I've got actually in my laptop when I go out looking at properties. And because what I want you to do is when you leave here today, I want you to think a little bit differently about how you buy a property. We want to look at, you know, things like we talked about, like what's our NOI, you know, our net operating, you know, income. And what are we talking about for cap rates? So if you have a true agent that's out there that knows investor talk, they're going to send you a highlight sheet, 3-bedroom, 2-bath, 11% cap rate, you know, 28% cash on cash with 20% down. You're going to start looking at that and in 2 seconds you go, I'll write it. I've got some of my investors that don't even go to the properties. They look at the numbers first, they write the offers, then they go on the inspection and see the property for the first time. Okay? Those are the relationships you do want to develop with you guys. As you get out there and you start making more investments, you want to surround yourself literally with a team that can accommodate that kind of an environment. And I'm talking everything right down to the contractors. Most agents will isolate a property, send you the sheet, you say I'm interested. We've already had our contractors through that property. We know what's wrong, we know what the cash flow is. And some of I was going to give you guys a couple quick little websites. I'm kind of a geek when it comes to that stuff. When you're looking in a certain area, I mean, right now, Twin Cities, we're under 2% vacancy, but you want to get very specific. The census.gov actually has very specific pockets. It'll show you from the census pockets of what the vacancy rates are. So you can say, I want to live on the north side of Brooklyn Park, north of 610, you know, east of this, west of that, and they'll show you the vacancies are actually at 1.2%. That's a real helpful thing. Another good one is that when you're running down the road, and I've said this before to you guys, I think, on our show, but the rent-o-meter is a good one. Rent range is another good one. I also like a site, this is actually, they have a cool app called Walk Score. That's all one word. And what's interesting about that is, like, you're in the neighborhood, you look at the for sale sign, you're out there to take a quick drive-by. Walk Score shows you, from a renter's perspective, what the rent should be on that house, what the vacancy rates are in that area, how walking distance is to buses. Because, you know, as an investor, you have to think a little bit differently than maybe if you were going to buy to own. Like, for example, you know, like with our single-family homes, one of my dad's favorite sites is greatschools.org. Because he knows that families that have children are interested in the schools, and that's how he markets his properties that are different. Because he says, hey, fantastic school district. You know, you talk about like Wayzata schools, you know, $1,800 a month, he can get another $400 a month for Wayzata versus $279 up in Brooklyn Park, Maple Grove, which is, I mean, we're talking 5 minutes apart. So pretty interesting stuff. So
what was the one you mentioned just previously, the great school? Walk?
Yep, there's one. Yep, WALKSCORE.com. And that's actually an app as well. So if you have a smartphone, if you want to play with that on there. Greatschools.org. And you know what I can do too is I've got so many of these different sites. What you want to do is pick the ones that you like, you're comfortable with, that fit you. Because I mean, what it seems like to me is when I even get properties thrown at myself, it's like, hey Andy, it's a 3-bedroom, 2-bath, and all of a sudden it's hitting you fast. So you want to just be able to feel comfortable, know your facts, know the people that are surrounding you. I'd say, if anything, when you leave today, get a team around you that you can trust, okay? From contractors all the way through. But going back to our worksheet, okay? Just take a quick peek at this. This is how, and I'd be more than happy to email this to you. This is something that I give to anybody that wants it. Talks about everything from the cash flow and how to analyze that, okay? You flip the page. This was kind of an interesting example. This is showing you another chart that you can plug this in as an exact example with your investment property you buy, where year one you put in your cash flow. And then you calculate your own appreciation. What's neat about this is that it shows you over the course of 15 years, you pay the property off, you've cash flowed over $55,000, for example, which actually that number looks a little bit light. Maybe my calculator was off there. And then the actual appreciated value is $165,000. So, and that's using on the front page the number I typed in there of a $100,000 house, okay? rolled it over there. So it gives you an example. So you can run these analytics, if you will, to kind of give you an idea of what you're getting into. The last page kind of just shows you what I think is important too, is that when you look at things like management companies, you look at should I do it myself or not. Looking at, for example, on your holding costs, this is what you look at if you, for example, own a property, it's paid for in full, or do you have debt service against it, you want to know your annual holding costs, especially if a market gets saturated, like now we have something ridiculous like 9,000 apartment units being released in the next 6 months in the Twin Cities. All these big buildings, whatever, and all these jobs, great, but the apartments are going to have a little bit of a flood right now. So we want to be careful. You want to make sure that you guys actually have properties that have the cash flow so that if the rent gets soft, you've got room to move, okay? Because you're not going to get the rates any lower, I know that. We all know that.
What's that going to do, that 2% vacancy rate?
Well, you know what I think it's going to be is I think you're going to see a lot of buildings with 60% vacancies, and then a lot of them are full. Because, you know, the market rate, the only way they get financing now with banks is they go to the bank and say, hey, I'm charging $1,600 a month for my uptown apartment for a 2-bedroom apartment. Well, there's a few people that will rent that, but then there's a lot of them that will say $1,600 a month. Wow, I'll stay where I'm at $900. You know, maybe even makes you even more secure as an existing owner, you know, having a property, you know. Maybe an opportunity for you to extend that lease for 3 years or something, you know. So, but on the average in the Twin Cities, we've seen every year 2.5% is kind of our average. You know, so as you're going in there calculating your numbers, that's a real steady number. I mean, almost in your leases, you should build it in as an accelerator every year if you can get away with it. I realize I can sit up here and tell you everything you want to hear, but when you get in front of a customer, then they're telling you, hey, you're not raising my rent. But that's considered to be in range of what's tolerable as well. So
What was that number?
2.5%. Okay, I'm going to give you guys my little bit of what I call a cheat sheet here too. Now, all of those charts that are in there, there's a couple, actually maybe I'll explain it before I hand it out. In this index here, it actually shows you things like, so when you're at home saying, well, what was he talking about net operating income? This shows you how to calculate that. So when you're inserting it into that chart, it tells you everything about cash on cash, NOIs, and I would be more than happy if any of you want to email me, call me. I love doing this stuff. So then I put in there a glossary, because if you're truly new, you don't want to go out there on your first appointment and not have some of the terminology down, right? You want to kind of sound like you know what you're doing. So I put these together for you guys. Was that right? Yeah, such as another helpful. Yeah. Okay, I know we've jumped all over the place tonight. How are you guys? Any questions for anybody?
How is it that principal reduction doesn't figure into this?
You know, a lot of times it depends on your business strategy. Some people don't do principal. Some people actually will stay finance, refinance, pull cash up. In the old days, most of the portfolio guys I know, whenever they get to 20% equity, they'd refi down to 5% and pull out their cash out and go buy more properties. So they're constantly leveraged. That's that whole concept of 5 to 1. And they went on to get to that ratio, and all of a sudden they have 100 properties in their portfolio, and they refinance, pull up $3 million, and also go out and buy a slew of new properties.
Well, maybe, but it's still return on the original investment.
True. Yeah, you can do principal reduction, sure. I mean, that's how I do it. I pay everything off. I go.
That number gets to be bigger than this one.
Oh, big time. Yeah. And you look down there too on year 15 on the bottom there. All of a sudden you see your income went to $9,000 a year instead of, you know, so it goes up significantly. So, and that didn't have any. I believe that also does not calculate in there the cost of your rent going up too. So if you're raising your rent every year, I think you should. Shouldn't say that. All right. So does anybody else have any questions?
There's been a really crappy year in the rental industry in this town, you know, 15% vacancy,
Yep.
rates frozen or declining. How often does that happen?
It happens. And that's why, like I was telling you here, I mean, with the economy that it was, and we have a lot of market rate apartments coming, the good thing, like we were just talking here too, you mentioned about having multifamily properties. I'm not afraid of diversity. I'm not afraid to say single family is one way to go, apartments, duplexes. You have to do what you're comfortable with. I'd say with investments in an area, if you live in an area you know is strong, and you know you like the area, it's good with rentals, not every pocket, just like with housing depreciation or values going down, is not the same. We're not all created equal. You know, so what I'd say is when you're spending your money, spend it like it's your money and spend it wisely. You know, pick areas that you know that you're comfortable with, and be picky. There's nothing wrong. I mean, I bet you right now our average investor writes 10 agreements before they get one. I mean, in most, like, I've got one coming in Corcoran right now. It's an estate. It's a family fixer-upper. I'll probably have 15 offers written on that property before we're done. It never hits the market, you know. So it's being resourceful, getting to know the right people, you know, and then hopefully, if you're not comfortable with flipping, but let's say that you do a version of flipping and you also do some holding or what they call portfolio investing, where you keep building a big portfolio for the income. Every strategy is different, you know. All of my strategies at this point are long-term holds for myself, so it doesn't matter what happens to the values. You know, I keep investing. My goal is to pay everything down. As I cash flow, I reinvest, and I just keep rolling. You know, but that's me. You know, so, and some people are different.
So, question. So, if you're in the entity of an LLC and you have capital gains, or my understanding too is now the new law under short sale, you have to pay capital gains on that. You're protected from an LLC, so not an individual. It's a portfolio that receives the capital gains, correct? So, is there a penalty in taxing? Because you're avoiding.
Are you saying? Okay, say that one more time so I understand 100%.
So we're going to invest. The idea is to invest your property under an LLC. So you buy a short sale. And my understanding is the new law is that under a short sale, the gain of profit, the gain of value is considered capital gains. So you buy a short sale, turn around, flip it. You made 50 grand. Besides the 50 grand, what you didn't pay, you still have to pay on the top of that too. Correct?
Okay. Well, here, let's back up. So in the event that you had someone that owned a property had to take a loss to sell it,
correct,
and the bank had, or I should say that, the bank had to take a loss, the seller is the one that takes the gain. They're the one that gets taxed on that gain at that point. You just got a good deal, okay? Now you own that property, you have nothing to do with, you know, you outsmarted the system, you bought a house at $50,000. Now we fix it up, we put it on the market, it goes for $150, sells in 2 days, and you make $50,000 of profit. Depending on how you're structured, that could be direct income, it could be capital gains. I mean, Jeff is probably a little better versed at that than I am.
Ownership of an LLC is, I mean, it's ownership of, you know, a security. I mean, the ownership interest. So, and an LLC is a pass-through entity. So, if it's a single-member entity, you report it on your personal tax return as sole proprietorship income. So, you're still going to, whatever the LLC does is going to pass through to the member or members. There's no separate return that the LLC does. If the LLC makes money, makes income, then it's going to be the owner of the LLC is going to be responsible for covering the tax. That's the first part. That's how the LLC works.
In this example that the gentleman's talking about here, your cost to buy that property is your basis, and that doesn't change.
correct.
It stays, that is the basis he's going to
Right.
have to work
Basis,
with
but-
for calculating any future gains.
But the
Right.
profitability gains, you're penalized. What I'm asking is, are you penalized because of my understanding of the new laws of the short sale? They enacted a 2% or whatever penalty it was because you bought a short. That's what I'm asking. I don't understand.
I haven't heard that. I'd love to, if you, you've got my card, email me anything you've got of that, because I haven't heard that yet. They talk, here's the thing that, and then I'll just say this. They talk about a lot of stuff on the news that never happens.
Right.
I mean, they're great initiatives. They bring a lot of things to the table, and they make sure that everybody knows about it, and then it never happens. You know, and that's where there's an inequity happening there in the eyes of the consumer, and sometimes in the eyes of the government looking at short sales saying, hey, you're profiting off of someone else's loss, and so they're trying to penalize you for that. Here's what I say to that. HUD, for the first time ever now, is not penalizing investors anymore. They're actually allowing you as an investor to buy. They finally are getting it. You got money. You've got good credit. A lot of the others don't. You know, the investor market, in my opinion, there's a reason why I'm here. I work with investors all the time because you guys are the ones that are going to heal our economy. You're going to stabilize our economy. And when the economy goes tough again, you hold on to your properties. You don't let them go back. That's the thing. And I think that what's happening is the more analytics and the more analyzing they do, they're starting to realize that. And eventually it's going to switch around again where you'll have some breaks. I don't think it'll be like the good old days, but you're going to see it where they're not going to make you feel like a jerk for having multiple properties. I mean, I hate to say it that way, but that's kind of the way they make you feel sometimes. Yeah.
A question back in this IRA investment. If you're taking money out of a Roth IRA and you sell the house and you make money on it, that money flows back into the IRA tax-free, right?
Correct.
So then why would it be?
If you take a distribution out, if it's the IRA, everything goes back into the IRA. If you own, let's say you own an LLC personally,
Okay.
that's different because the IRA is exempt from tax. You personally are not.
I guess I missed the question.
Yeah. If it's your IRA, correct. It just goes back into the,
It goes back into the LLC bank account. The IRA is responsible for paying tax on it.
It's a funny thing though, because you mentioned specifically Roth. Let's say you have a SEP or a SAR SEP, and collectively you have the amount of money you need to buy one property. They don't like you doing it together. They want to be separate entities. So if you have $30,000 in an IRA that's a Roth, you got to kind of keep them separate. And I'm not the attorney, Jeff's here for a reason, but I've been in deals where they want you to keep that separate. There's a couple different ways to look at that. So you buy a property, and like I always see flippers, like the contractor that buys the property. They don't have capital gains problems because they lost $1,000 when they sold the house. The construction company made $70,000 on the remodel job. They put the money where they want it. And so that's the kind of the creative part of being a self-employed person. Or if you're in an IRA, for an example, and you have, you beat up the contractor, for instance, you try to get the best deal you can from the contractor.
You beat them up.
You beat them up. Yeah, you beat them up and you squeeze them. And basically then the money comes back, goes right back into your Roth. And yeah. So, different strategies.
That probably should be the last question. Again, kind of
it's okay.
But when you have a Roth, you have to start taking proceeds out when you get to be whatever, 70.5. If you're fully invested as much as real estate, what happens to you?
I don't think that's true on Roth. 70.5 applies to standard IRAs. A Roth IRA, that's free and clear. But I think what we're trying to understand here is that within the IRA structure, be it standard or Roth, whatever the rules are that apply to IRAs applies to any gains generated by that IRA. So in the case of if you own the real estate in the Roth IRA, it would be my expectation, and I think the understanding is correct, that you'll never pay tax on that gain. And when you take distributions from the Roth IRA, there's no tax paid on it. That's the beauty, one of the beauties of the Roth IRAs. It's a vehicle that you can allow to have an investment grow and grow and grow and grow and be totally tax-free. It's not just tax deferred, it's tax-free.
I mean, with the Roth, I mean, it's what happens. I mean, it's too good to be true, kind of the way he described it, because it is. Right. And it's like, so let's say that I bought a property, took my Roth IRA, took my $30,000, and then I went out there and I financed with this lending company, and I financed and bought a house, had it flipped, and made $100,000 profit. Now my $30,000 IRA is worth $130,000, and I'm not supposed to pay taxes. That's where you get really in that area of, when you get audited. But the rules are the rules.
Right,
Follow the rules.
Because then you can pass it on to your children.
Exactly.
To enjoy it tax-free, and
absolutely.
You want to build family wealth.
There are some restrictions in terms of withdrawing too soon after you've started a Roth IRA, for instance. But I think it's 5 years, and once you're past that, then it's just kind of clear sailing beyond that.
Well, something else to think about here. I've got another group actually that does in North Minneapolis. It helps, like for example, convicts that have been in jail. They help them rehab. They buy properties, you guys, to give back. They buy properties so they break, even if not lose money, so they can provide a service to the community too. There's other ways you can do this. It doesn't have to be all about profit. Even though that's fun, it doesn't have to be. It can be a gift-giving thing. It can be a generosity thing. You can help people out. I know I've got a doctor that I've worked with up in Andover several times has bought properties, and then when the church has a family that's in the church that needs help, they stay there for free. So there's some cool things you can do too. So, I mean, I always spend the profit side because that's what I get paid to do. But I mean, just from the other side of the fence. My mom makes me say that stuff. So, any further questions? Otherwise, you guys, thank you for coming. Yeah.
Can you talk a little bit about those loans that you can get to help fix up a property?
Fix up funds?
Is it a 203?
Are you talking about buying a new property that you need to have additional money for fixing?
By new, I don't mean new construction.
Okay. Are you talking about like getting a loan in your existing house?
No, one you're going to buy.
Yeah, then there's several different products out there. You've got the FHA product. If you haven't taken, you can have 2 primary residents, I believe, which is the new rule that they're changing, that you can actually get a 203K on, which is a fancy name for a fix-up loan. And there's 2 kinds. There's a streamline, which is up to $35,000, which is kind of fast. And there's the main line, which can be up to 2/3 of the value of the purchase of the property. Lengthier process. So you bought a house for $100,000, they'll lend you up to another $75,000, for an extensive rehab. There's also Fannie Mae, Freddie Mac. They all have properties. You can buy their bank-owned properties where they provide some fix-up funds as well. Otherwise, there's Minnesota Housing Finance, has fix-up funds, so if you own your existing house or rental property even, you can qualify to have fix-up funds released to you at a pretty fair rate. Funds are limited there. And then one of our sponsors on the show, Cambria Mortgage, actually the Cambria countertop guys, if in the remodel job you use anything Cambria, countertops or flippers, listen to this is a great deal. Countertops, Cambria. The rest of the house you can borrow up to $40,000 interest-free for up to 12 months.
Wow.
Yeah. So now all of a sudden you're doing your improvements and you're not paying anybody for the interest. As long as you put Cambria on the, you know. So that's one I can't believe more people don't take advantage of. And so.
I wondered when I looked at the screen, I mean, man, that sure looks like the same company, and I guess it is.
Yeah, the Davis family, they've done very well. They with their well, they started in the cheese business, funny enough.
Yeah.
Yeah, they come from Davis Co. They make like the Kraft macaroni and cheese, and then they bought the countertop company, which went bankrupt, I believe, and they bought it out of bankruptcy court and turned it into a gold mine. So they're a very smart family, good family. I love being part of their group. So, you know,
Sounds like a good one.
yeah.
Talking about things you hear on the news and do they ever come true or not, is that true now that there's a 3% charge fee that's tax on sales of houses after the first of this year?
Oh, on the health, because of
The healthcare?
Yeah.
You want to comment? Go ahead and comment.
Yeah, if you actually go, I think you did a legal minute. We talked about it at the state fair that day with the accountant from the show too. There is a 3.8%, I guess, Medicare surtax, and it applies for its individuals with income. I forget if it's gross adjusted or.
Right.
There's some, I forget what the measure is, but the dollar figure is $450,000. So if you're above that, it applies. So
Probably
certain
affects guys
things-
like you, Jeff.
Yeah, I wish.
No, it is. It's one of those deals where all the stars have to align. The property has to have so much appreciation or capital gains. Your income that year has to be so much, and then it eventually it's there. But like I said to you before, the odds of that, it's still in the background. It's coming with that healthcare plan as it's coming forward, and they're reorganizing that healthcare plan as it happens. Who knows if it'll ever officially become law?
That's a surtax on the capital gain tax.
Correct.
Yep.
Correct.
Yep.
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 Yeah, I guess.
They kept calling in during the political season on that one, trying to get me in trouble. And of course, I'm like, sure it exists. Yeah, no, but it's true. They got to figure out a lot of ways to pay for things now. I mean, there's a lot of stuff to pay for, you know.
Yeah.
So.
I didn't get your card.
Okay. You betcha. Yeah, if anybody has any questions, or if you guys want to get those Excel spreadsheets that I handed out, that's on that sheet there, I'll email them to you, or however you want. That's this one here. This one.
Yep.
That actually comes live, and I can actually. You didn't get one, did you?
Okay. I'll just email you and ask for.
Yeah. Yep. Just ask for the spreadsheet.
These calculations. Huh?
Yeah.
All right. Fine.
I'll tell you what. That's a lot of fun because you can pull one out of the paper.